Hi, my name is Tere Castellanos and I'm going to talk about taxation and income policy in microeconomics. I choose this topic because it's something that affects all of us, even if we don't realize it. Taxes and income policies are key tools that government use to organize the economic control, how resources are distributed, and make sure people have access to the things they need like education, health, and public service. Let's start with taxation. Taxes are mandatory payments that people and companies make to the government. The money collected from taxes is used to build schools, hospitals, roads, and many other services that benefit society. Without taxes, a country wouldn't be able to function properly. From a microeconomic point of view, taxation influences the behavior of consumers and producers. For example, when taxes on products increases, the price of those goods also rises. Because of this, people may buy less and companies may produce less. On the other hand, if taxes are reduced, people usually have more money to spend, which increases demand. There are many kinds of taxes. The most common one are income tax, which is the tax on the money that individuals earn from their jobs. Corporate tax, which companies pay based on their profits. And sales tax, which is added to goods and services when we make a purchase. Taxes are important because they help balance the economy, but if taxes are too high, people may feel discouraging to work, invest, or start a business. If taxes are too low, the government won't have enough money to provide essential service. That's why finding the right level of taxation is so important. Now let's talk about income policies. Income policies are action or laws that the government uses to control or influence how much people earn. One common example is the minimum wage, which helps protect workers by making sure they receive fair pay for their work. Another example is a progressive tax system, where people who earn more money pay a higher percent in taxes. This system helps reduce inequality and allows the government to support those who have lower income. Income policies can also include things like subsidies, social programs, or salary regulation. For instance, some governments give financial support to low-income families or to students, so they can have better opportunities. Both taxation and income policies are connected because they aim to make the economy more stable and fair. When they are applied correctly, they can reduce poverty, promote equality, and encourage economic growth. But if they are poorly managed, they can cause problems such as unemployment, inflation, or unfair wealth distribution. In everyday life, we can see the effects of these policies. For example, when the price of certain goods increases because of new taxes, or when workers receive a salary rises because of new income regulation. Those are results of economic decisions made by the government. These changes affect not only companies but also families, students, and consumers like us. To conclude, taxation and income policies are essential tools in microeconomics that influences how money is moved through society. They shape our behaviors as consumers and producers, and they help define the kind of economics we live in. Understanding how taxes and income policies work allows us to be more conscientious citizens. It helps us realize that every decision, like buying a product, working a job, or saving money, is connected to economic policies. In the end, both taxation and income policies are not just numbers or laws. They are ways to build a more balanced and fair society.